Hello, friends. Welcome to this macro series, and we are beginning with inflation. So today's audio would cover the basics of inflation. Let's begin. So, inflation, as most of us have read in elementary economics, that inflation is rise in value of essential rise in prices of essential commodities. So essentially, it is a consumer price index that is published by central banks across the globe. In my opinion, however, that is not the definition but an example of inflation. The actual definition of inflation is drop in the purchasing power of money. That is, let's say I'm able to buy today a pen, one pen for 10 rupees, and maybe 2 months down the line, same 10 rupees, can get now are getting me 2 pence. So the purchasing power of this 10 rupee note has increased. On the other hand, it might happen that these 10 rupees, the cost of the pen would quite possibly rise above 10. So the purchasing power of the 10 rupee note has dropped. Now I'm not getting even a single pen. So when the purchasing power of money drops, it's called inflation. This could be, the purchasing power of money could drop due to three factors. One is demand pull, cost push, and monetary inflation. So demand pull is quite simple. Let me tell you that we are going to look at these individuals, the factors in great detail later on. Right now, I'm just introducing you to these concepts. So demand pull inflation, as the name suggests, is that the demand exceeds supply and the prices rise. So most of you would say, "Oh, that's good thing actually," especially in case of consumption-driven economies like India or United States. If demand pull inflation is rising due to demand-side pressures, it's a good thing. Then you have cost push inflation, in which case the rise of commodities rise, prices of commodities rise, oil spikes, and that ends up pushing the final prices of goods higher. Then you have monetary inflation, which is of more, it's I would say monetary inflation is simply money supply. So here is the it might get a little complex here, but always remember that money is also a commodity, and if the supply of commodity rises, its value drops. So when central banks or governments, they boost money supply, it ends up pushing the value of money lower. So whatever you measure in terms of money, it may be stocks, real estate, essential food items, everything, whatever you measure in terms of money, that starts looking costlier. I can give you an example of that. Is 10 years back, you might be buying a certain pen which costed, let's say 5 rupees. Now if you want to buy the same pen, its price might have increased to 7, 8, or even 10 rupees. The obvious explanation for that would be, one possible explanation would be, oh, the demand must have spiked in the last 10 years. But also remember that the standard of living has gone up, and high quality pens have also come out in the last 10 years. So it's quite possible that consumers would have shifted to the high quality pens. So it's not, you cannot confidently say that it's the rise in value of that particular pen is due to demand side pressures. It could be due to cost push, or simply it is just that monetary base has expanded and it has pushed the value of money lower. Always remember this, that when you consider money as a commodity, then we are essentially in a barter system. So we are exchanging one commodity for another. Consider money as a commodity. So we are exchanging commodity for rice, consumer durables, vegetables, what and what not. So here is how I see money. I see money as a commodity, and I think across the globe we have assumed that this particular commodity would be used as a medium of exchange, and as they do in foreign exchange markets. Let's say you are studying euro dollar. So if the supply of euro rises, when the money supply rises, obviously euro dollar should depreciate, right? That is, euro should depreciate against the US dollar. In same way, as assume everything that is valued in terms of money, consider it as an exchange rate. Okay, so let's say one pen costs uh, 10 rupees. So pen slash INR is equal to 10. Now if I increase the money supply of INR, as I said earlier, that would push the value of money lower. So that pen slash INR, the exchange rate which was 10, now it would go up to 10, 12, 13, 14, 15. That's the effect of money supply. And hence I believe that inflation is not the rise in prices of essential commodities. It's an example of inflation. The actual definition is it's the drop in the purchasing power of money. And the next important thing that one need to understand is that it's more often than not it's due to increased money supply. And wherever this money supply is, excess money supply enters in whichever sector of the economy, prices tend to rise, go up there. For example, if the money supply goes into stock markets, we have a stock market rally. Essentially, it's inflation. If this money supply goes into construction sector, the cost in the construction sector would rise. So this was the I would say introduction to inflation, and I'll be putting out another audio tomorrow, and where we will be discussing core inflation and headline inflation, and why central banks, when they look through the headline inflation, they are making a big mistake. I shall explain you that tomorrow. That's it for today. Adios.